Hi, I'm Peter Rose, founder of Longwood Currency Trading. Are you afraid to lose trading Forex? That's a real inhibitor, I guess, for most people, particularly those that are 40, 50 years of age and up, in getting into Forex because all they see is the risk that's involved. But because they don't understand the risk mitigation that we use in our trading plans, all they see is the risk of loss. They don't see the mitigation of that risk, what we can take stops and just thinking rationally. I was listening to a video that Etienne did on his Desire to Trade network with Mike, and I made a comment on it because they were talking about crazy shit that they had done and big losses that they had. Even though they were risk management experts, they still lost huge amounts of money and weren't really cognizant of why that happened. And it was simply through a lot of repetition that they were able to work their way out of that and to not make such crazy mistakes. Although we all tend to make mistakes because we're the ones that are in charge of the button. If you don't push the button to close, it's going to run wild on you. So why don't we push that button? And I think the problem here is that we're being greedy at the wrong time. We think about that position that we've entered, and that's a big decision that you're going to put your money at risk, right? So you have some methodology for evaluating price action at that particular time to determine whether you want to bid ask and get in the game. And so what the mind is doing is saying, oh, this is a great opportunity. All the little check boxes that give me a good trade are in place, and so I'm going to get in and I'm going to take that trade. The mistake that you make is that you fall in love with that trade. This is what it all comes down to, because that's your greed. Once you have satisfied all the rules of your entry condition, then you shouldn't have any more fear, because the rule is written to give you the highest probability that the trade is going to work for you. And so we go into that, right, with a high level of confidence, with a lot of enthusiasm that the trade is going to be successful on a probabilistic standpoint. It's like pulling a handle on a slot machine. You know, you've pulled it, 80 times and you've lost. And so the big one is sure to come at some point. The probabilities are very difficult to deal with because sometimes that pull doesn't work out. And sometimes that trade doesn't work out. But it's recognizing that. That's why we have stops, right? The problem is that we're in charge of setting that stop. If you're an active trader and you're going to you're trading for a couple hours a day, as I teach in my fast track course, the process for making your trading work at a 2-hour period of time, because you've got to get off and get to work. You don't want to trade when you come home, when you're beat and you got dinner to do and the kids and all that kind of stuff. And maybe after everyone goes to bed, maybe you could trade, but you're beat, you're tired, and all you're thinking about is getting up in the morning and going to the job. So it's best to get up in the morning and give it a couple hours. If all you've got is an hour, you can still do this, but it's ideal for a couple of hours to do that, because if you have a good set of entry conditions for your rule, you can immediately go in to the trading platform at the designated time and you go, is there anything I need to do right now? Is there anything that could happen in the next 2 hours that looks like price action may establish a direction and give me an opportunity to trade? Or is there nothing to do at all? If there's nothing to do, I'm just going to go to work, or I'll catch an extra couple hours of sleep, or whatever I'm going to do. I don't have to worry about that because I'm retired. But the training that I provide is for my students because they're all working. So when we get those entry conditions and we've got 2 hours to trade, we're going to chew up maybe 15 minutes or 20 minutes watching the market and doing whatever dance that you do to determine whether you're going to be able to get into that trade or not. But that's building in anticipation. It's like watching the first part of a movie. They make that the best. They grip your attention. Or reading a book, they grip your attention in the first 5 pages of the book or in the first couple of minutes of the movie. And you go, well, I wonder what's going to happen to Bob. And so you continue to watch the movie. So you're doing that in that first 20 minutes is that you're establishing the justification of the trade to fit within the market conditions at that time and how you feel and all that stuff. You're settling in. And then you make that decision to take that trade. You've got time invested in that trade. And the longer you take to make that decision, the more invested you become in the trade. And there's the key of the video, is that the longer that you take to determine whether to hit bid ask, is the more you fall in love with that trade and the less likely you are to get out quickly. If you don't get out quickly, you could let it go 30 or 40 pips before you go, oh, I give up. If you limit yourself to 5 pip loss, let's just be ridiculous because most of the like the 5-minute candles on the majors are 5 period, right? And so you've got 5 pips on your 5 minute time frame. So 5 pips is really nothing. You're going to get japped out of that all the time until you get really good at making those entry decisions. But even in the point of being good, you still take that trade and it goes against you. It's always going to go against you, 1.5 pips anyway. But if you've got the correct momentum right, it shouldn't go 8 or 10 pips against you. If you want to wait 10 pips, then you've got to make an awful lot of pips on your winning trades, or you have to have a really good win-to-loss ratio in order to make up for those 10 pip losses, those 20 pip losses. If you're a 80% win-loss, you can take a 20 pip hit because you're not going to hit that very often. You take 2 20 pip hits and the other 8 you make 10. So you make 80 minus 40 and you get 40 pips over the 10 trades. You're okay. But our emotions get involved in that and become invested in it. So you have to make a game of it. If it goes 5 pips against you, you get out. So if you take 2 or 3 5 pip losses, let's say you take 3, you just got to figure that you're out of sync with the market, that your entry analysis isn't really good that day. So shut it down. You've lost 15 pips for the day. Okay. If you're a 70-30 trader, which you should be, you could do the math on that and figure out what your average winning value needs to be in order to overcome the 15 pip loss that you're going to have. The key to the whole thing, though, is no matter who we are, when we hit bid ask based on good, solid entry analysis, we're in love with that trade. Gordon Gekko said, you don't get emotional. You don't get emotional about money, and you can't. But we are, because that's why we're trading. We're trying to make a lot of money. We're trying to replace our job income. And it's hard to separate that out as an end goal from the immediate goal, which is don't get whacked too bad. Once you take that position, once you're in that trade, then you would think that's time to be greedy. And it is time to be greedy. Once you're established as a trader, that's a good way to be, because then you push it and you're adding and staging in. But as we're getting started, maybe we're trading maybe you only have a 3 or 5 lot capability. You're not staging and building positions in 3 to 5 lots. You're going all in, all out, because the odds, the math works out that you make more doing that than you would building and staging. So if you're all in, all out, and you're wrapped up in any kind of exuberance over, God, I found a trade, you're going to want to stay with that. And that, once that trade starts to go negative on you, you are retaining your greed. And that is when you should be fearful of loss. Not fearful of loss when you take the trade because your rule conditions take care of that of the loss component right up front in entering the trade. You just get rid of that because the loss is mitigated for you in your trading plan. But once that goes against you, if you're sort of a 60-40 trader, or you're in a difficult market conditions, you don't want to take that 10 pip loss. You just don't want to go out that far. You should have more of a fear of loss than you have a desire for gain. And it really works the other way, right? When we're losing trades, we have that desire to, oh, it's going to come back. It's going to be, okay. My conditions wouldn't have been that wrong on me. Okay, I'm 5 pips down. Oh, well, it'll come back because it's only 5 pips. Oh, now it's 10 pips down. Well, let me jump up to the 5-minute or the 15-minute chart. I'm on a 5. Let me jump up to the 15-minute chart. Oh, geez, it's got 10 more pips to go before it hits the 55 and support line, and so I'll wait there. And then, well, I'll jump up to you just all crazy shit in your head. And that's the days where you'll take the 40 or 50 pip loss. And once you get up to 30 pips and above, you go, well, let's look at the daily chart. Daily chart's got 100 pip ATR. I'm 30 pips, 40 pips down. I'll just do this as a carry trade and we'll go from there. Now you're going to find yourself 200 pips down. That's what the fuck is going to happen. I know that because I've had that happen. Until I figured out how to incorporate these fear during the loss instead of the greed. You can't just say, oh, I'm greedy when I should be fearful, because you don't have the ability to make that decision at runtime. So your rules have to provide the mechanism to deal with. And until I realized how severe the flip was, that as the price was going down, that we were all being greedy instead of fearful. We were only fearful at taking the trade, and that really isn't the way it should be done. In any event, when I'm working with students on that fast track program, toward the end of the program, it's only 6 weeks, but toward the end of the program, we get into these nuances and stuff, and we're only trading $1,000 account, $1 a pip. And so getting out at 5 pips, even though they may do that 8 times in a day, they learn very rapidly that there's a cutoff. They're wrong in their evaluation. And so you learn by losing small amounts of money. Even though the percentage against the bank is enormous, it's still a small amount of money. But it still hurts. You lose a pizza in a day, and that hurts. And so you have to look at that and say, what am I doing wrong? Well, I'm doing 2 things wrong. Number one, my entry analysis isn't correct because it's going against me too many times. And number 2 is that because it is going against me too many times, I'm getting hit, and I'm getting that 5 pip loss. Well, what would have happened if I would have extended the stop to 10 pips? Oh shit! Yeah, I'd have got hit. Instead of getting hit 5 times on 5 pips, I'm getting hit 5 times on 10 pips. I'm really in tough shape. And so the questions that come out to me at that point are, oh, I feel so stupid and blah, 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 and I can't trade and I'm going to give this shit up. Hey, Bob, it's only $1,000. You've only lost $300 or $400 of your account. You can easily go and re-put that $300 or $400 in because it's only $300 or $400. If it was $30,000, it'd be a little more difficult to do that, wouldn't it, Bob? But it's only $300 or $400. It's 30% or 40% of $1,000 account. You may be down if you're in the U.S. You may be down past margin. Right now, $660 you need on that, just to play the game on some of the major pairs. $660 out of the 1,000 that's margin. You're left with $3. So you really have to get your shit nailed down early in to your entry analysis thought process. Is that your entry analysis? Well, you have to understand the line where you go from entry analysis to position management. If you think that as soon as you hit bid ask because you met your entry conditions that you're now in position management, that's probably one of the reasons that you're losing. And in fact, when I talk with students about their previous trading and stuff, I say, well, you're managing this trade and it's not ready to be managed yet. And so you rework the view that you have of their entry rules to incorporate stuff that you need to be thinking about and doing that can be resolved by having rules until you move into your position management stage of the game. And it's very simple to get to that position management by having some rules, even with the short stop and getting bumped out, because once you move into a certain level, then the risk goes away. You're playing with the house money, or maybe you're going to be able to just get a very minimal. Maybe you're going for 15 pips, but if you get away with 2 pip win, you're doing really good. But that's all part of position management sometimes, because it can still be part of the entry phase of the life cycle of a currency position, which is entry analysis, position management, and exit methodology. Those are the 3 rules that I teach in my fast track course. And as I was saying, the boundary condition between entry analysis and position management is well defined, but if you don't know where that well-defined part is, you're using the wrong rules at the wrong time. And that's why a lot of you are probably getting into positive profitable trades, and yet you're still losing because you don't understand what you need to do and when you need to do it. Well, you might know what to do, but you're getting the when component of that wrong, right? And that's got to be part of the rule. And there's some of those conditions imply the transitional point between the entry and the exit. The entry and the position management phases of that life cycle. But what I'm talking about right now today is the trade goes negative against you, whether you've been positive and all this other shit, but all of a sudden now you're in a negative position. And now you should be terrified, not afraid, but you should be terrified, and you should just cut it and go. The idea here, though, is when you're day trading, you're on the board and you're there all the time. I get very casual about my trading like I did today because I've got a really good daily win to loss value of about 83%. I think probably this year I'm down a little bit from that, but running maybe about 80% on a daily basis. So I figure that in the end, over the days that I run, I can make up for my momentary lapses when I go out 30 or 40 pips and take a hit, or when I do some staging and I get really loaded up and the thing swings around on me and I don't get fearful enough. And because there's more money involved then, And I'm saying I'm adding to this position because I think it's going to continue to go. It should go. It should go. And that's the kiss of death. It should go. It shouldn't do anything. I don't have any crystal ball. When the fucking thing turns around and goes a little bit against me, I should get out. When I do that, I do fine. Last month, that's what I did. I did fine because I was there. I was focused. Everything was going great. I made 12% last month. This month, I'll probably use up a lot of that 12% gain that I had last month. But that's my fault. It's not the fault of the rules. It's my fault for being a little too casual sometimes because I've been doing this for so long, I get complacent. And so I'm not focusing on the fear enough. And I realize that. And so I have to be willing to pay for my fears. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.